Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, we're lucky enough to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing this morning?
I'm doing great. It's a pleasure to be here.
Pleasure to have you, and timely as well. We've had this big move in yields to talk about at a time when inflation expectations are moderating. Inflation has come in quite a bit. So I was wondering if you could unpack what's happening in yields, and particularly at the long end of the curve, what you think is driving it and what your outlook is going forward.
Yeah, well, first let me say that we are a little bit surprised to see that 10-year Treasury yields have hit a new cycle high. They hit about a 435 yesterday, and that's a cycle high. That's actually about a 16-year high. We did expect that yields would eventually reach those levels by the end of next year, but with a recession happening along the way. But the reason why we haven't seen yields reverse lower and we did see a new cycle high is because, well, one, the recession has not hit. That still seems at least a few quarters away. And two, what's happening here is real yields are rising. That is, inflation-adjusted yields are rising. Yes, the market has ticked its inflation expectations up a little bit along the way. Those have risen about 15 to 20 basis points over the last few months. But what's really happened is you've seen real yields rise drastically, about 100 basis points over the last quarter. That's a pretty good sized move, and that's being driven by predominantly supply-driven pressures or fears, not really the Fed itself. And what we mean by that is quite simply, the Federal Reserve is continuing to reduce its holdings of Treasuries. The Treasury itself has increased its auction for the upcoming quarter and its auction expectations for the coming quarters. And so the market is having to pre-position for an increase in supply across the curve. And what that's done is that's really shifted real yields higher as the market is adjusting. So it's been quite a bit of a move, and we're reaching levels now where you should expect to see filter through or feed through effects to other asset classes, particularly credit and equities. It's just starting right now, it appears, but the longer 10-year Treasury yields stay where they are, the more pressure there's going to be on other asset classes.
And so thinking about how to position for a move like this, obviously fairly unexpected, but is this a time where you would be adding to long-term treasuries or adding to duration? I mean, if we're at cycle highs and maybe there's some momentum, but ultimately if we're near or close to peak Fed and we expect them to ease policy at some point in the future, even if it's not in the immediate term, is this a good time to be adding to longer-term treasuries, longer-term high-quality fixed income?
We believe it is. We have added duration in our fixed income portfolios in the last month, and we would expect that if yields continue to rise from here, that we would again add additional units of duration. We're about a quarter of a year long duration versus our benchmark, and we could easily see adding another quarter of a year, moving out to a half a year long if 10-year Treasury yields continue to drift higher. So we do think this is a good time to buy, but I have to caution. This is predicated on the view that the U.S. economy is going to slow down in the next 2 quarters. If the U.S. were to accelerate, that is, somehow see an increase in both real growth and or inflation, then clearly Treasury yields don't have much downside from these current levels. But we do expect to see a slowdown, and we do expect to see a flight to quality into Treasuries as that slowdown becomes more pervasive. And we do expect that to happen, if not by the end of this year, then by early 2024. So we would be adding duration at this point.
So could you break down that economic outlook for me? Obviously, this year has kind of been defined by the unexpected momentum in the economy, and a lot of it's driven by a resilient consumer and a resilient labor market. What prompts you to think things will slow down, or that the recession call is kind of still in play in the next couple of quarters?
Yeah, well, I'd say a lot of the resurgent consumer and resurgent growth in 2023 was driven by a liquidity infusion in the early portion of the year back in March, when Silicon Valley Bank and other regional banks were collapsing. The Fed and the FDIC injected quite a bit of liquidity into the economy. The Treasury also did so during that period, heading into the debt ceiling. So the amount of liquidity injected was close to $1 trillion, and much of that filtered through into consumers' pockets. That liquidity is reversing now, and it's reversing at a fairly accelerated clip. So much of the we'll call it the tailwind that consumers had is being removed and is now forming a headwind. So that's one reason why we would expect the economy to slow. Although a consumer slowdown doesn't necessarily lead to a recession, it should bring the U.S. economy back towards a stall speed, where if there is an additional shock elsewhere, it could and very likely would tip the U.S. economy into recession. But the other point I would add is that there's quite a bit more liquidity drain to come here from the Fed's balance sheet reduction, as well as the prospect of at least one more additional hike from the Fed. Although I don't think the Fed is going to hike one more time, the market is not so sure, and it's pretty close to a 50-50 bet that they do tighten again. So there's going to be more liquidity drain in the second half of the year, and that should be another headwind for consumers and businesses as well. And credit cracks continue to emerge throughout the economy. They just are emerging quite slowly as 2023 progresses.
Well, Tom, that's really, really great insight. Appreciate it as always. We'll keep an eye on yields from here and hopefully get to talk to you again soon to get an update on your economic outlook. But once again, thank you so much for the time today.
Thank you.